We've been interviewing leading economists about what's next for the economy and for the stock market. Today, we're speaking with Michelle Meyer. She's head of U.S. economics at Bank of America Merrill Lynch. Michelle, thanks so much for talking with us today.
My pleasure. Thank you for having me.
I want to start out with sort of what you see as the overall outlook for the U.S. economy right now, where we are today.
Sure. So I've been thinking about the trajectory in phases. So the first phase of the cycle was the lockdown. It was the recession. It was the extreme decline of economic activity. The second phase of the cycle, which I've been calling a transition phase, which is when the economy reopens, stimulus funds are flowing in, and you get this big bounce in economic activity. But that phase, unfortunately, we think is largely over. And now we're entering the third phase, which is the healing phase. And this is the part of the cycle where things are going to be a little bit harder. It's going to be a bumpy ride ahead. And the growth that we're going to see looking forward will be a function of the path of the virus, the health response to that, the degree of stimulus that we see both in terms of monetary and, very importantly, fiscal policy, and how much the economy can handle the reallocation of dollars we've seen in terms of how people are spending, where people are living, and how businesses are being able to conduct their business in this new environment.
How does your forecast for the jobs market play into that? We've obviously seen some jobs come back, but still very high level of unemployment. So what's your view of the progress and the path forward for the labor market?
The best way to think about it, frankly, is that there's just a lot of flows both in and out of the labor market right now. People are getting jobs. We're seeing it in terms of the reports from companies and clearly from the jobs numbers. So people are getting hired back, but there's still people who are separated from the labor market that are losing jobs, that are filing for jobless claims. So really big flows of people in and out of the labor force. We think the June jobs report will mark as will be the high water mark in terms of monthly job growth. But we do anticipate we will see further job creation in the months ahead. It just won't be quite as strong as we had seen in June.
Even with these kind of record low unemployment rates earlier this year, wages were never surging. So will it take a while for wages to increase and come back and for people's salaries to go up now?
So wages, as you noted, were what we call kind of sticky after the last recession. So it took a while to start to see a real push of wages, even when the unemployment rate was really, really low, or by some measures through what we would consider that kind of optimal level of unemployment rate. In March and in April with the jobs report, we actually saw wages rise substantially because of the shifting in the workforce. More of the jobs lost were in the lower paid jobs, and therefore aggregate wages actually looked like they were improving. And that's reversing now, but it's going to take time. And then on an individual level, companies are going to have to decide how much resources and how much money they can put towards paying their workers, how many people to have employed, and also how much to pay them. So generally speaking, when you have such a high unemployment rate as we do now, the bargaining power is much more for the employer than the employee.
How would you assess the Fed's policy so far? Unprecedented stimulus at a very, very fast pace.
So I would give high marks in terms of the speed of the response, but also the programs. If you think about the Fed in particular, they didn't stop. They didn't stop with just announcing one program or two programs. They announced 11 different credit facilities, and they continued to adapt depending on the feedback they got from markets of what worked, how to price it, where there were signs of dysfunction or stress in the markets that they tried to address. And then obviously with their more pure monetary policy tools in terms of keeping interest rates low for a long period of time, I think that's been rewarding.
What would you say has been the impact of the Fed's policies on the stock market overall?
It's been proven in the last cycle, and I think today too, that market participants react to stimulus, of course, right? These are dollars being pumped into the economy, and particularly from what the Fed did on their credit facilities, they were directly targeting parts of the market, particularly credit markets, the bond market, trying to depress the level of interest rates, tighten spreads, and naturally equities are going to respond favorably and positively to that. So I do think it's fair to make the case that monetary and fiscal policy has helped to drive higher the stock market, just like monetary and fiscal policy is being used to support the real economy.
Do you see any sort of bubbles in the economy given these high valuations, whether it's the stock market or the housing market? Is there anywhere you're worried about right now as an economist?
whenever there's an extreme amount of monetary and fiscal policy, you have to consider what that might do in the future, and obviously financial stability risks and all of that will probably come to the forefront at some point in the medium term. But I don't think it's the story right now. Certainly not for the Federal Reserve in terms of influencing their monetary policy decisions going forward.
How about the inflation risk? That's one that we hear a lot about with all of the so-called money printing that's going on. Is that something that worries you or not so much?
I'm more worried about disinflation than inflation on the upside. I think if we actually get inflation on the upside, that will be a good problem, because it would show that we're seeing a drop in the unemployment rate and wages are picking up and people have more purchasing power, and the dynamics that should play out for seeing high inflation would. But to me, the inflationary story right now is much more driven by the fact that we've had a big demand shock, and that demand shock has created, downward pressure on overall prices. So, in the last few months, the inflation numbers that we were looking at were filled with what we would call kind of idiosyncratic movements, certain components that swung around dramatically as a result of how the COVID pandemic played out for the consumer. And we're going to now see more of that underlying trend going forward, right? So once we get past the noise, it's going to be a function of what is the underlying trend? What should we really think for purchasing power of the consumer, and how much are they able to spend? We also have to normalize inventory levels. There's a lot that has to go on before we can truly understand what's happening on the price front. But I would say in the medium term, it's more of a story of disinflation than certainly upside inflation risks.
And on that same note, do you worry about the debt that's been accumulated with all the stimulus and the possibility that, the deficit is continuing to increase at such a record pace here?
Yeah, the deficit expansion has been dramatic. And I think what we have to remember is that the deficit expansion was happening even before COVID hit. So we were seeing, in a way, on an unsustainable path for the deficit. And then obviously once COVID hit and we had this incredible amount of support from Washington that is ongoing, deficit continued to swell. So, what's the concern? I think the concern is what happens on the other side. So once we get past the crisis, do we start to see some, efforts to rein in the deficit, shrink the deficit? And what does that mean for, reduction in spending? What does that mean for policies going forward, especially since we do have a potential change of government? There's lots of moving parts in terms of how to think about the budget going forward. But I think for the time being, the consensus very much on both sides of the aisle is for more deficit expansion as we do what's needed to stimulate the economy.
Do you worry at all about companies taking on more debt? We've seen so much bond issuance, and do you worry about individuals taking on debt, or is that, again, sort of a not for now problem in your view?
Yeah, so in a way, the fact that they're taking on more debt is a way of bridging the gap, right? In the sense of, how do you get through this crisis period, especially for corporate America, where the revenues might be down? You can continue to pay your bills, you can keep your doors open by taking on debt as a bridge, and then hopefully once the economy stabilizes, once your business stabilizes, you can work through that. So, I think it depends on the duration, how long people are taking on debt, the degree of it, relative to their prior income stream. But debt service is also very, very low. So, you can lock in a very low level of interest rates, which makes it a lot more manageable. So it's not just the level of debt to consider, it's also the debt service, thinking the level of interest rates. And I think from the household side, debt service has been very low, not necessarily on the corporate side, right? There you've seen bigger swelling of the balance sheet, but on the household side, households have really been, really focused on seemingly reducing their debt overhang, and debt service was running at historic lows heading into this crisis.
And how much do you worry about the kind of economic inequality or income inequality that has been very highly exposed during the pandemic?
So I think it is a really big concern. You can look at the literature, it's crystal clear. The more inequality we have, the lower the trend growth in the economy. So the middle class is so important to be able to create opportunities and to create access to wealth and to income in order to spend. So again, that goes back to the idea of, what's the appropriate course of action from a policy perspective? I think it is to address those issues and try to create an environment that works for everybody, especially after so many have been hit really, really hard from the pandemic. And it's not an easy thing to do. And you hear from, for example, Fed Chair Powell talks a lot about this, and it's something that I think is really important to a lot of folks within the Federal Reserve. You look at the research that's coming out of the institution, but it's very hard to address that through monetary policy. It's kind of a blunt instrument to deal with that, but it's not on the fiscal front. So it'll be really, I think, important to see the types of policies that go through in the next year or two to address these issues.